Hello and welcome to this Prepare to Pass series on financial management. My name is Waleed and I teach this paper and the advanced version of this paper at PwC's Academy in Dubai. I put my contact email there so that if you have got any questions after this webinar series is over, you can feel free to drop me a line and I will try to get back to you ASAP. Some important links, and today we will be using the first link, which is the CBE specimen and extra constructed response questions. So kindly open this link while we are still going over some overview on today's topic, as we will be using the first link very soon. So this was the plan for the 4 sessions. We are already done with the 2 sessions, and now we're on to session 3, which is going to focus on another core area of financial management, which is working capital. For session 1, we did something on investment appraisal, went over some good questions. Session 2, we went over business finance, quite an exhausting day on this business finance, and then we did some really good questions. And then I left some homework questions for you to do on business finance. And this is where we are today. So today, we are going to have a look at working capital. The aim, as always, will be to go over the key working capital concepts and then to cover some questions. And we will see how far we can go this session. I have taken some really good questions on working capital. So there are 5 long questions here. We will be focusing on the first 2 for this webinar series, and then you can use the others as part of your homework. Now, that said, what we can do now is that we can have a look at some overview on working capital and then take it from there. So on to session 3. The first thing that we need to do on working capital is to be able to calculate the working capital. That is the simplest thing we have to do. So on working capital, the first thing we have to do is to be able to calculate the working capital. And the calculation of working capital is simple. It is the current assets minus the current liabilities. Current assets minus the current liabilities. Now, what are the most important current assets for us? Well, our assets are obviously the cash, inventory, receivables. So the 3 most important current assets for us are cash, inventory, receivables. Some of our current liabilities are the payables and the overdraft. Now, what are we going to do in this area is we are going to look at ways how we can manage these individual components within this calculation effectively. So the aim of working capital management is to manage these components well and effectively. So we are today going to see how we can best manage cash, how we can best manage inventory, how we can best manage receivables, payables, and then the overdraft. Before we jump into that part, the key part here for us is to understand a very important concept on profitability versus liquidity. Profitability versus liquidity. Profitability versus liquidity. Profitability, as we know is to generate returns for the shareholders, to generate profits for the shareholders. And liquidity is to have enough cash in hand so that the business operations can run smoothly. Now, a good financial manager will always aim to balance liquidity and profitability. Now, excess of any of these two is bad. If we have too much profitability and less liquidity, if we have too much profitability and less liquidity, can you tell me by writing in the comments box or the question box that if we have too much profitability and we have less liquidity, what is the danger there? So if we have too much profitability and less liquidity, that is to have cash. So this is to have profits, and this is to have cash. So what's the danger of having too much profitability and less liquidity? Okay, some good answers coming in now. We will not be able to pay our expenses, not being able to meet current liabilities, yes, not have enough cash to pay creditors. We may be over trading. That's another interesting concept on working capital. We'll not be able to meet daily expenses on time. Higher risk, difficulty to manage. Yes, you're all right. Well done. So if we have too much profitability and less liquidity, the danger there is that we may go out of business. We may be liquidated. We may have some bankruptcy risk. We may not have enough cash to pay people. Now, on the other side of things, if we have too much liquidity and not enough profitability, then what is the danger there? So if we have too much liquidity and not enough profitability, what's the danger there? Too much liquidity and not enough profitability. What is the danger there? Write your comments on the question box. Okay. Yes, good one. Less dividends payable and retained earnings and not investing the cash to gain interest. Profits will be low. Yes, less dividend. Yes, you're hitting the right areas now. So if we have too much liquidity and less profitability, that means the shareholders are going to suffer because shareholders will not have enough profits now. And that means they will have less dividends and less retained earnings. So now you understand what is the problem here. Yeah. Well done. Yes, good points. So as we understand the problem now, we are saying that here we need a balance of liquidity and profitability. This is quite a frequent requirement on this exam, where the examining team in working capital asks us that why do you think profitability and liquidity are vital, or what are the issues involved here? So this is what you need to say. You need to say, well, if there is too much profitability and less liquidity, we have a danger of running out of cash. If there is too much liquidity and less profitability, then the shareholders are suffering. And a good financial manager will always aim to balance out these two concepts. So I hope that was useful in terms of an overview of this important point. Now, let's jump into something to do with cash. And we're going to see the cash operating cycle. Cash operating cycle. Or sometimes it is also called the cash conversion cycle. Cash operating cycle or cash conversion cycle. Now, when we do any business transaction, what is the first step? The first step is we have the payables. So we create the payables. The first thing is we have the payables because we have to buy something from the supplier to be able to then convert it into something or then to sell it. So we have payables. The second step is that we'll have some inventory. And once we'll convert that inventory to sales, we will eventually have some receivables. We'll have some receivables. Now, there are three important aspects here. Once we create the payables, then we have the payables days, because that is the time period we'll pay will take to pay off the payables. When we have inventory, we'll have inventory days. That how much time do we take to keep the inventory in our stocks or warehouses? And then when we make the sale on credit, then we get receivables days. That is, how much time do we take to receive our money from the sale? Now, what is cash operating cycle? It is the time difference. It is the time difference between paying and getting paid. Paying to whom? Paying to the payables. And getting paid from whom? Getting paid from the receivables. So when exactly do we pay the suppliers? And then when exactly do we get the money back from receivables? That time period or time difference is computed by the cash operating cycle. So when do we pay the payables and when do we receive from the receivables? So that is the time difference called the cash operating cycle. Now we need to be able to calculate these things here. Payables. So we can say creditors over the payables, whatever you want to say, over the cost of sales or the purchases. So usually it's the cost of sales into 365 usually, unless the examining team specifies something else. The inventory days, we take inventory over the cost of sales into the 365. And then receivables, we take receivables or the debtors, they both mean the same thing, debtors, receivables, over the sales into the 365. So in this way, once we have computed these 3 days, we can then find the cash operating cycle. Cash operating cycle. Cash operating cycle is what I call IDC. 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 I is inventory days. So I is inventory days. D is debtor days. And C is creditor days. And this gives us the cash operating cycle. Yeah, so you can also remember this with a quick memory at IDC, which is I don't care. So I is inventory, D is debtor, and C is creditors. So this is the situation we have. Thinking about the cash operating cycle. So difference between paying and getting paid, and we can compute it by taking inventory days, debtor days, and creditor days, and there are all the formulas involved here. Now, another question which sometimes comes up in the exam is that what is a good operating cycle? So what is good cash operating cycle? Well, it is not easy to answer this question because it depends on a lot of things. The things it depends on number one, the type of business you are. I.e., are you a retail business or business to business or B2B? So are you B2C, business to consumer, or are you business to business, the B2B? Because this will determine your cash operating cycle. Because the retail businesses are usually in cash and the business to business transactions are on credit. Number two, what is your industry? I.e., are you a service-based industry or manufacturing-based industry? Because if you are a service-based industry, then you are not having any inventory. If you're a service-based industry, then you are not creating the opportunity of having, let's say, the payables or a lot of receivables, because it's mostly cash-based. And if you're a manufacturing industry, then there are payable days, then there are inventory days, there are receivable days. So all these are things which impact a cash operating cycle. So B2C is business to consumer, business to consumer. And that is called retail, business to consumer. And business to business is where one business deals with another. So this is how we know that what is a cash operating cycle. Now, next thing, we need to step into a bit of receivables management. A bit of receivables management. Now, when we think of receivables management, there is a key calculation that we need to get right. Key calculation. And that key calculation here is that we need to take our receivables balance. We need to take our receivables balance and multiply that with the overdraft rate. And multiply that with the overdraft rate as a percentage. So receivables balance into overdraft rate in a percentage. This calculation gives us cost of financing receivables. This gives us cost of financing receivables. Now, can I ask you to tell me that why do you think I am multiplying my overdraft rate with the receivables balance here? Why are we multiplying the overdraft rate with the receivables balance here? What do you think? So what's the benefit of multiplying the overdraft rate with the receivables balance? Okay, a few answers coming in. The first one is interest saved. No, I don't agree with that. To find out opportunity cost of what? We can earn interest on the amount which is tied up. Yes, I like that. Taking back overdraft as substitute. Because you don't have the receivables, so you borrow and pay overdraft. Yes, I like that. Yes, good answers. Yes, thank you. Yes, cost of receivables. Yes, well done. So basically, there's a concept which we need to understand. So can I have your maximum attention here? When we have receivables on our balance sheet under current assets, whenever we have receivables on our balance sheet under current asset, that means this money is not with us. This money is with the people. This money is with the customers. This money is with the receivables. So then how would we manage or use the funds in our operational needs? What we will do to arrange funds for our operational needs. So if this money is with the customers, if it is with the receivables, then how would we fulfill our operational needs? Well, what we are going to do is we are going to borrow the equivalent from the bank as an overdraft and pay interest on it. And that is why it is called cost of financing the receivables. Cost of financing the receivables. Now, this is an extremely important calculation and the one which we will be doing in the exam quite often. So receivables balance into overdraft rate gives us cost of financing receivables. Why is that? Because receivables balance is with the customers, not with us. So how would we meet our operational needs? Well, we'll meet our operational needs by borrowing the equivalent from the bank as an overdraft and paying the overdraft interest on that. Okay, now, what is the trick that can be played here? The trick that can be played here in the exam is that we won't have the receivables balance. The question is then how to find the receivables balance. Because the overdraft rate will be given nice and clear, there is no problem with that. The only issue that may happen is that we may have to find the receivables balance. Now, to find the receivables balance, what we can do? Well, what you may have given in the exam is receivables days. And I've already shown you the calculation of receivable days, which is the receivables balance over the sales into 365. Now, if the examining team has given us the receivable days and they give us the sales, well, what we can do then is we can rearrange this calculation to find the receivables balance. And therefore, the receivables would then be the sales into receivables days over 365. So, really important calculation. The receivable days are receivables balance over the sales into 365. If the examining team gives us the receivable days and they give us the sales, we can find that receivables balance. And then the receivables balance would be the sales into receivable days over 365. Please remember this calculation as we will be needing this. And once we have got the receivables balance, then we simply multiply it with the overdraft rate to find the cost of financing the receivables. Okay, so I hope that is okay. Really, really important idea from the calculations perspective. Now, one last thing on receivables, a bit to understand, that on receivables, what are the benefits of having receivables? What is the benefit of having the receivables? What is the benefit of having the receivables? And then what is the cost of having receivables? Cost of having receivables. So first of all, I want to know from you that what do you think is a benefit to a business of having the receivables? What is the benefit to the business of having the receivables? Well, the benefit is increased sales. The benefit is increased sales. Yes, because who doesn't like to buy things now and pay later? Who doesn't like buying things now and pay later? So the benefit here is increased sales. The benefit here is perhaps the customer loyalty, because the customers would then be loyal to your business and they would have a recurring sales, and that loyalty would also result in increased sales. And yes, attract customers, I like that as well. Perfectly okay. What would be the cost of having receivables? Well, the cost here would be the bad debts, as some of you are already pointing out, because some customers are not going to pay. We are going to have increase in admin cost. Yes, we're also having increase in admin cost because someone has to sit there and do all this work. And the third one, which, yes, you're saying right, cost of financing, which we just saw earlier above. So these are all the costs, and these are some of the benefits. Now, a good financial manager here will try to ensure that the cost is less than the benefits. So a good financial manager will ensure that the cost is less than the benefit. The cost is less than the benefit. Yeah. Okay, so this is what we need to know for now as a quick revision series on receivables. Of course, we will go into a question and do more. One last thing before we go into the next part is a requirement which sometimes asks us on receivables policy, that how we should design a good receivables policy. How do you design a good receivables policy? Well, a good receivables policy has got three elements. Number one, we should be able to assess credit worthiness. we should be able to assess credit worthiness of our customers. Credit worthiness of customers. Number two, we should be able to think of some T&Cs, the terms and conditions. And number three, we should be looking at operational management of the receivables, or the day-to-day management of the receivables. So to think of receivables policy, three things, and I will do a question very shortly with you where I will talk about the detailed things within these headings. Now, the next thing before we go into the question is to think of inventory. Or the inventory management. Now, within inventory management, the key calculation for us is the EOQ, the economic order quantity. Economic order quantity, EOQ. That is the key thing for us. EOQ, economic order quantity. Well, we can compute economic order quantity with this formula. Economic order quantity. The three things here, the C naught, the D, and CH. C naught is the cost per order, or the ordering cost. D is your annual demand, and CH is the holding cost per unit per annum. So holding cost per unit per annum. That is our EOQ. Now, what does EOQ tell us? That is the next question. So I'll leave that question to you now. So tell me, what is EOQ trying to determine? What is EOQ trying to determine for us? So what is EOQ trying to determine for us? So give me your answers here. What is EOQ trying to determine? Brilliant. Again, some really good answers. Some of the answers are that it looks at an ordering level at which the costs are minimum, minimize the cost for an order. We need to reorder the quantity of order we should place where the costs are minimum. Yes, all good. Yes. So just to summarize this, EOQ tells us the quantity to order, so that the costs are minimum. The costs are minimum. That is what EOQ is trying to tell us. How much to order when the costs are limited. Now, what I'm liking in your answers is that all of you are trying to explain in your own words, and all of these are absolutely okay. So feel confident going with this in the exam. Do not look to learn things, too many things from the textbooks, and try and explain things in your own words, and that is all okay. Now, few of the calculations here. The examining team can ask you to find the total inventory cost. They can ask you to find the total inventory cost. And the total inventory cost is made up of three things. Number one, the purchase cost. Number two, the total ordering cost. And number three, the total holding cost. Total holding cost. Three things. Well, the purchase cost, or the total purchase cost, is simply the units into cost per unit. So units are your demand into the cost per unit. Units are demand into the cost per unit. That's easy. The total ordering cost is D over the Q. D over the Q gives us the number of orders, and then into the CO, which is the cost per order. So D, demand, over Q, the quantity, into the C naught. And then total holding cost is Q, the quantity that you order, over the 2 into CH. So we take an average quantity that we order, because sometimes you order more, sometimes you order less. So what is an average quantity that we order into the CH, which is the holding cost per unit per annum. Again, these three calculations are vital as you will be using them. So Q is the quantity to order, which could be your EOQ, quantity to order. Now, another thing here is that the examining team sometimes asks us to evaluate if we opt for bulk discounts. To evaluate if we should opt for bulk discounts. Now, bulk discounts are the discounts given. So first of all, we need to understand this. Bulk discounts are the discounts given for ordering a specific quantity. So discount given for ordering a specific quantity. So what are we going to do here? Well, what are we going to do here is we are going to compare total cost when EOQ with total cost in quantity of bulk discounts. So the quantity under the EOQ and the quantity under the bulk discounts. And we are going to work their total cost out. So total cost in EOQ quantity and total cost in bulk discounts quantity. Now, this is the situation what we have on hand to do the inventory bits. So can I now ask you to go into a question? First of all, if there are any questions there, so any questions up to any questions? The question here is, can you scroll down to the EOQ formula? Yes, I can. And what is optimal EOQ? Okay, let's see this. So this is the EOQ formula, the 2 COD over CH. And optimal EOQ is the best EOQ, and EOQ is already the point at which the cost is minimum. So whether you say optimal EOQ or you just say EOQ, at both of these points, your costs are minimum. So there isn't any much difference in them. So if you've got any other questions here, I'm happy to answer at this point. Any other quick questions here? So we are going to do all this. We are going to calculate EOQ. We will look at the total cost, and then we will look at the idea of bulk discounts as well, where we will compare the total cost in EOQ with total cost in the quantity of bulk discounts. And then we will choose for the best option. So any final questions here before we jump into a question? Any final questions here? So can I just ask you to please go into this link, which is the extra constructed response questions link. And the question we're going to have a look at there, this is the extra constructed response questions. And the question we're going to look at here is the one on KXP. Okay, so we have the another question here. The question is, how do you calculate buffer inventory? Well, the buffer inventory information would be given to us in the exam. So the examining team can tell us that, let's say, the buffer inventory is 5 or 10% of the total demand. So that buffer inventory information has to be given to us by the examining team. So if you can go to extra constructed response questions, and there's a question there called KXP. If you are not being able to access that link, then it is already in the documents with this webinar. So this question is already there in the documents to this webinar, the KXP question. So we can just take it from there as well. I think the link is a bit down. So you can take the question from this documents with this webinar, the KXP question. Okay, so while that recovers, we can just go into the question from here, which is within this webinar, the 20 marker. So let's see the requirements here. It says calculate the net benefit or the cost of the proposed changes in the receivables policy, and then comment on your findings. So we have to do two things here. We have to find the net benefit or cost of the proposed changes in trade receivables policy, and then we have to comment on our findings for 6 marks. And again, we'll need to know what are the proposed changes. So let's take this question one by one, requirement to requirement, and let's just first do the proposed changes bit. So let's have a look at this question. This is a past question, which has now been made available in extra constructed response questions for students to practice. A really good question on working capital. So KXP is an e-business which trades solely over the internet. In the last year, the company had sales of $15 million. They were on 30 days credit to commercial customers. So this is the original days that were given, or the credit days that were given, 30 days, and the sales have $15 million. The extracts from the company's most recent statement of financial position relating to working capital are as follows. So we have receivables, we have payables, and we have overdraft. So this is the current receivables balance. Current receivables balance is 2466. In order to encourage the customers to pay on time, KXP proposes introducing an early settlement discount. Okay, so there is some early settlement discount of 1% for payment within 30 days. Remember, this discount is also the cost. It is the cost of having receivables, the 1%, while increasing its normal credit period to 45 days. So from 30 to 45 days. It is expected that on average, 50% of customers will take the discount and pay within 30 days. 50% of customers will take the discount and pay within 30 days. So there's a bit of an analysis building up here. So 50% of customers will pay in 30 days. Then we have 30% of customers which will pay after 45 days. And then we have 20% of customers which will pay after, which will not change their current paying behavior. Now, what is their current paying behavior? Now, with this information here, when I have the trade receivables balance, I have the sales, and I know that there are 365 days in this year. Can you calculate the current receivable days for me? Can you please calculate the current receivable days here for me? So we have the receivables balance, 2466. We have the sales, which is 15 million. And I know there are 365 days. So can you find the current receivables days? Current receivables days. Yeah, right answers coming in, 60 days. So what you're doing is you're taking 2466,000 over 15 million into 365, and you're getting 60 days, which means 20% of customers will take 60 days. Now, although the business originally granted them 30 days, but the current receivables balance is showing that these people are taking 60 days. Okay, well done to all who have given the right answers. Well done, yes. So this is the proposed structure. 50% people will pay in 30 days, and these people will get some discount, which is 1%. 30% customers will pay after 45 days, and 20% customers will take 60 days, which is the current paying behavior. Now, the only thing which I need from this question is to know the last line. We'll come back to this later. KXP has overdraft facility charging interest at 6% per year. So 6% is the interest rate. The overdraft interest is 6%. Now, that's it. This is all the information we have on receivables. Can I know if you have any quick questions here before I go into the workings on this question? So any quick questions before I go into the workings on this question? So working now the extra constructed response questions. So any questions here before I go into the workings on this question? So within the extra constructed response questions, this will be the first question you will see there, KXP. So any questions on the scenario here first? The question here is, the discount scheme is for customers who pay within 30 days. Yes, the customers who pay within 30 days will get 1% discount. How do you calculate the current receivable days and sales are for last year? Well, the last year's sales would have given us the receivables balance for the year ended, and that year ended balance is giving us the receivable days. So receivable days are calculated from SOFP, which is for the year ended, for the entire year. So that year's balances are being used to work out the receivable days. The next question is how found the current behavior 60 days. It's simply the receivables over the sales into the 365. So why are the 30% customers paying early? Well, they're not paying. They are going to pay early here. As per the question, they're going to get the discount. So if they pay in 30 days, they will get a 1% discount. So that is an incentive for them to pay early. So they can get a discount of 1% if they pay within 30 days. Any more questions here on this? Now, before I go into this working, can I please ask you to revisit this calculation where we talked about the receivables balance, cost of financing, and the idea of finding the receivables balance? Can you please keep this in front of you? So key calculation is receivables balance into overdraft rate. That gives us cost of financing receivables. And how do you find the receivables balance? We have the receivable days, we have the sales, and we can find the receivables balance, which is receivables balance equaling sales into receivable days over 365. Please keep this in front of you. Keep this one in front of you. Now, let's go into this question then. Let's try and do this. What we are going to find is the net benefit or the cost. Net benefit or the cost. Now, the first thing is we can find the current cost of financing. Current cost of financing the receivables. How can we find the current cost of financing receivables? Can someone help me here? How we can find the current cost of financing the receivables? Current cost of financing the receivables. Current cost of financing the receivables. Yes, some right answers coming in. We have the receivables balance and we have the overdraft rate. So that should be easy. The receivables balance here is 2466,000 and the overdraft rate in this question is 6%. So 2466,000, the overdraft rate is 6%. and that gives us 147,960. 147,960. So receivables 2,466,000 into 6%, which is the overdraft rate. That gives us the cost of financing. Yes, well done. All of you getting that right. Well done. Now, what I need to do is I need to find the revised cost of financing. I need to find the revised cost of financing because there are some changes which are taking place. Now, in terms of revised cost of financing, remember, this company has going to split their customers into 3 layers. 50% customers will take discount and pay in 30 days. So 50% customers will pay in 30 days. Then we have 30% customers who will take 45 days. And then we have 20% customers who will not change their current paying behavior. And we already found out that their current paying behavior was 60 days, which is the receivables balance of 2,466 over the sales of 15 million into 365. So this is the structure. Now, what I need here is a calculation where I can find the cost of financing 50% customers who take 30 days. And what I want you to focus on now is this calculation. How to find the receivables balance. Sales into receivable days over 365. So let's try this here. So sales, which is 15 million. How many customers will take the 30 days? Well, 50% customers will take the 30 days, 50%. Into how many days they will take 30? What are the total days? 365. So what I've done here is I've done this same working again. What I've done is I've taken sales, thought about the proportion of customers who are going to take this offer, and then into the receivable days, which is 30, as these customers will take 30 days over the 365. So sales, 50% of customers will take this into 30 over 365. Can someone tell me that at this point, with this calculation which I'm showing you here, 15 million, 50%, 30 over 365, what would this calculation give me? Just this part, this one in the brackets. So sales, 50%, 30 over 365. What are we trying to calculate here with this calculation in the brackets? So that's what I need from you. What are we calculating? Yes, I know the number, but what is that showing? What is that showing? Brilliant. Yes, these are the receivables. These are the receivables balance for the people who take the discount and they take 30 days. This is the receivables balance. This is the receivables balance. So 15 million, 50%, 30 over 365 receivables balance. Now what I'll do with this receivables balance is that I will multiply this. I will multiply this receivables balance with the overdraft rate, which is 6%. And this will give me the cost of financing the receivables who take 30 days. This gives us the cost of financing the receivables who take 30 days. Okay, so that is our cost of financing the receivables who take 30 days. That is 36,986. Is everyone okay with this calculation? Any question on this one first before we go into the next ones? Any questions on this calculation first? So we've got the cost of financing receivables who take 30 days. That is what we have just found out now. Okay, let's do the same calculation for 45 days now. So what I'll do is, I'll say, well, equal to 15 million. How many percent customers will take? 30% customers will take. How many days? 45 over 365. And then into 6%. So receivables balance, or the customers who take 45 days into the overdraft rate, gives us the cost of financing the receivables, who take the 45 days. Now, done. And the next thing is the 20% customers who take 60 days. So 15 million, 20% customers, they take 60 days over 365 into the 6%. 20%, 60 over 365 into 6%. And this gives us the cost of financing receivables who take 60 days, which are 20%, and their cost of financing comes out to be this number. So the cost of financing is 29,589. Okay, any questions up to this point? Any quick questions up to this point? So same calculation. Do not forget this. Do not forget this, because students forget this. They forget that what are we trying to do here? We're trying to find the receivables balance. We need the sales. We need the receivable days or 365 to find the receivables balance. And that's what we've done here. Taking the sales proportion, because the proportions were there, 50%, into receivable days or 365 into the 6%. And then with the same calculation for the other two as well. Now, this has given me the cost of financing. But is that all the cost involved here? Well, no, that is not all the cost. There's a cost of discount as well. There's a cost of discount as well. And the cost of discount is simply 1%. So the total sales, 15 million. 50% customers will take this, and we take 1% as the cost of discount. So 15 million sales, 50% customers will take the discount, and the discount percentage is 1%. Which means that the cost of discount here comes out to be $75,000. Which means the total revised cost of financing is sum of B7 to B11. And the revised cost of financing comes out to be 174,863. 174,863. Now, if your current financing cost is 147 and the revised cost of financing is coming out to be 174, would you like to go for the revised scenario? Would you like to go for the new proposal, or would you like to stick with your current management of the receivables? Would you like to go with the revised proposal? What do you think? Question, would you like to go with the revised proposal, or would you like to stick with your current structure of managing the receivables? What would you like to do here? Questions? Yes, stick with the current policy. We can't do a revised proposal here because that is more costly. So the current, yes, current, yes, well done. So the current situation is better, as revised proposal will increase the cost of the company. And we can work out that increase in cost. An increase in cost is the B13 minus the B3. And that's it. So this is what we had to do here. The increase in cost is 26,903. In terms of the marks, this was a 6-mark requirement. We got the 1 mark here. Would have got 1 mark here, 1 mark here, 1 here, 1 for the discount, and then 1 for this final commit. So 6 marks in total on this requirement. Now, I'm now open to any questions at this point. Okay, so I'll show the cost of discount calculation in a second. Show the cost of discount calculation in a second. cost of discount is this, the 15 million sales, 50% customers take the discount, and the discount rate is 1%. So the cost of discount is $75,000. The question here is, if bad debt is given, what will be the calculation? There is no standard calculation on that. You will have to follow the examination team's instructions there. So whatever percentage of bad debts they tell you, they are the cost, and you'll need to add the cost here. But we don't have any standard which I can give you. So this is what the examining team expects you to read that information and find that from there. So let's say they say that bad debts are 5% of the total sales. Then take the 5% and add them to wherever you're going to do. Let's say on the revised cost of financing, we'll add the 5% bad debts there. So it is a cost, but how that cost has to be computed, we do not know. The examining team has to tell us that information. So there's a question here saying, well, I don't understand how we're getting current receivables from last year's sales. Well, this extract from the company's most recent statement of financial position is here. That means this receivables balance is from the most recent statement of financial position, which is at the year end. So this is the most recent trade receivables. And if these trade receivables are being used to calculate the receivable days, then they are the most recent or the current receivable days. So I hope that is okay. Any more questions here before we move on? Good requirement. Really, really good question, thinking about the receivables management. Any final questions before we move on? Okay, seems all good. Let's now go into the part B on this question. And the next part is to calculate whether the bulk purchase discount offered by the supplier is financially acceptable and comment on the assumptions made by your calculations for 6 marks. We need to read this scenario here. So KXP currently orders 15,000 units per month of product Z, demand for which is constant. So we can find the annual demand here. So 15,000 units per month into 12 will give us the annual demand. There is only one supplier of product Z, and the cost of product Z purchases over the last year was $540,000. So this is the total cost for product Z, the purchase cost, $540,000. The supplier has offered a 2% discount for orders of product Z of 30,000 units or more. So this is the quantity we need to order to get the bulk discounts. And the quantity we need to order here is 30,000 units. Each order costs $150, and the holding cost is 0.24 per unit per year. So this is the CO and this is the CH, holding cost per unit per annum. And that's it. Now, before I do this one, can I take your attention and revise this bit, how to work out the EOQ? 2 COD over CH. We have the CO, we have the annual demand, we can work out the annual demand, and then the CH. And once this is done, this is a key calculation. Working out the total inventory cost on purchase cost, total ordering cost, and the total holding cost. So remember these calculations, D over Q into CO, Q over 2 into CH. And then this is what we are going to do now. We're going to compare total cost under EOQ. So we'll first find that EOQ quantity, and then we'll find the total cost under EOQ, and then compare it with the quantity under the bulk discounts. And remember, the quantity under the bulk discounts is already given to us, which is 30,000 units or more. So any quick questions on the scenario before we go into answering this? Can I have any quick questions here on this scenario before we go into answering this one? Any quick questions here before we go into answering this one? Okay, yes, the questions are coming in. Why are we calculating EOQ? and it didn't say anything about the EOQ. Well, it didn't say, but I said. So I said that this is how we deal with the bulk discounts. We compare the total cost under EOQ with the total cost under the bulk discounts. So this is how this requirement or this area is solved. So this is what I want you to do. Yeah, this is what I want you to do. Any other quick questions here? Any other quick questions? Will we compare 30,000 units with EOQ or the current purchasing? Yes, we'll compare the 30,000 units with the EOQ. Okay, fine, good. Let's go into solving this now. Let's go into solving this. So we're looking to evaluate the bulk discounts scenario. First thing is to work out the EOQ. Now, sometimes students find it difficult to calculate EOQ on a spreadsheet. Well, it is not difficult because there is a function SQRT to take the square root. And then 2 into the CO. The CO is 150. What is the annual demand? The annual demand is here. So 15,000 units per month into the 12. So 15,000 units per month into the 12. That's an easy one. So that is 15,000 units into the 12. So we can find the annual demand there. So 15,000 units into 12, easy, 180,000. So we can put the 180,000 here, or you can do 15 into 12 as well. And then over the C naught. Over the CH, which is the 0.24. So 2 COD, 2 COD over the CH. 2 COD over the CH. That gives us the thing within the bracket, and we take the square root of that, and that comes out to be 15,000. So what was given here was actually the EOQ, but it's worth checking that always. So 15,000 units is the EOQ here. So SQRT, please remember this, SQRT, to take the square root, and in brackets 2 into CO into D over CH. This is how we work out the EOQ. Now, what we need here is the total cost calculation. And we need to do total cost calculation in 2 scenarios. The first scenario is if the Q is 15,000. And the second scenario is if the Q is 30,000. The Q is 15,000, Q is 30,000. And we are going to work out the purchase cost. We're going to work out the total ordering cost, and we'll work out the total holding cost. Total ordering cost and total holding cost. So how much was the purchase last year? It was $550,000. So when they were ordering 15,000 units a month, that means the purchase cost was $540,000. So done. How can we find the total ordering cost here? Let's go back to that calculation to find the total ordering cost. D over the Q into CO. So the D is 180,000. So 180,000 over the Q, which is 15,000, into the C naught, which is 150. So D over the Q into C naught, which is 150. How do we find the total holding cost? Well, it's Q over the 2 into CH. So the Q is 15,000. So 15,000 over the 2 into CH, which is 0.24. And we get this as 1,800 as well. Which means the total cost here under the EOQ is sum of C8 to C12. 543,600. 543,600. That is the total cost. Any questions here with computing the total cost under the Q, which is the 15,000? Any questions here computing this total cost under the Q? How do you find the purchase cost? Well, the purchase cost is given. It's $540,000 given, the purchases. Now, let's go into the Q, the bulk discounts. Well, how much discount are we going to get? 2%. So what we'll simply do is we'll take this 540 again, the C8, and we'll take 98% of that. What this will do now is it means that we have deducted the 2% discount from the total purchase cost of $540,000. We have deducted the 2% discount from the total purchase cost of $540,000. This is what this calculation is doing. So let's do this. 540,000, 98%. That means the cost now, the discounted cost is 529,200. Total ordering cost again, D over the Q. D is 180,000. The Q is 30,000 into the C naught, which is 150. Remember, the Q now is 30,000 over the into the 150, and then total holding cost. The Q is 30,000 divided by 2 into the holding cost per unit per annum, 0.24, and that gives us our final answer. So we've got a total cost of 543,600 under EOQ, and we've got a total cost of 533,700 under the bulk discount quantity. Now, can I ask you that which of these quantities would you like to go for? Would you like to go for the Q, or would you like to go for the bulk discount quantity? Yes, avail the bulk discount quantity. Yes, agreed. So opt for bulk discount quantity as it is cheaper. And it would usually be cheaper because that's how the discounts work. The discounts do decrease your cost, so it would usually be cheaper. So this was the requirement here on this. Can I now take any questions at this point? So if you've got any questions at this point, I'm very happy to answer any questions at this point on this working on the bulk discounts. Yes, all of you have given the right answer. Any questions here on this requirement before we move on? The question should be for 30,000. Yes. So yes, we'll go for the quantity of 30,000. The purchase cost should be for 30,000 different. Well, this here is the quantity that we're going to order. This is not the demand. The demand is the same in both the scenarios. So our demand is still 180,000. This is just how much quantity we will order. So that doesn't mean our purchase cost will change by much. The purchase cost will still be the old purchase cost and taking off the discount of 2%. This is the quantity to order and not the demand. The annual demand still remains the same. Okay, final question. Calculation of EOQ in CB space. Once again, please. Well, here is it. SQRT brackets 2 into CO into D. This is the demand. You could have worked this out as well. 15,000 into 12 here in this over the 0.24, which is the holding cost per unit per annum. So this was another 6 marks that we got here on this requirement. Now, last thing, the next requirement on this question is the idea of looking at the factors to be considered in formulating a trade receivables management policy. So whenever the examining team wants you to think about the trade receivables management or their policy, we always think of we always think of those three headings. And the three headings which I talked to you here, which were the assessing creditworthiness, the TNCs, and operational management. Now, this requirement is worth 8 marks. And I need to know how much to write. So how would you structure this answer? I mean, we can't just start aimlessly. We need to think of ways how we will structure this answer. So what do you suggest? How would you structure this answer? How would you gain these 8 marks? What is your plan here? How much do you think you have to write to get these 8 marks? So can you let me know your planning? How would you plan to get these 8 marks on this exam? A few answers coming in. The answers are: give 4 points and explain receivables, write everything we know is not the best choice. So it's not about knowing everything. It's about knowing the right thing in right time. Discursive answer, explaining each heading. Yes, I like that. 4 points on different methods of receivables. For each of heading respectively. Yes, so people who are giving me this answer where you're telling me that we will go with the headings. So there are 3 headings here: assess creditworthiness, terms and conditions, and operational management of the receivables. These are the 3 headings which I'm going to create. And then I'm going to talk within these 3 headings. Now, if I talk within these headings and the total marks are 8, I'm looking at maximum of 3 marks under each heading. So 3 marks under each heading. And 3 marks means 3 good points. 3 good points explained well will give me 3 marks. So 3 marks under each heading will give me a maximum of 8. So this could be 3, 3, 2, or 3, 2, 3, whatever you like. So maximum of 8 points, 8 marks, but split under the 3 headings. This is how you need to plan. So I get this question quite a lot, that how do we ensure our discursive answers are good? Well, the first thing is you need to plan. You can't just start aimlessly. So here the 8 marks would require you to create 3 headings and then talk within these 3 headings. So we have been practicing a lot of discussion on the first 2 sessions as well. So I hope that was useful, and I'm sure that today's discussion would be very useful as well. So let's just try putting an answer here. So the factors can be split in 3 headings. The first one is to assess the creditworthiness. Assess the creditworthiness. Now, I need your help with this answer because I can't write this answer all alone. I need some input from you to make it more exciting. So can you give me some points here that how would you assess a customer's creditworthiness? So write some points there for me. How would you assess a customer's creditworthiness? So a few answers starting to come in. The first one is to look at their credit rating. Then someone is saying through the bank. Look at the past record. Look at the credit rating agency, the reputation, media, past experience. Visit the premises of customer, their website, requesting credit rating, internal credit scoring, financial statements, Google, financial reports, published information, all are well. Yes, all these points, references, all these points are perfectly okay. But do I need to write everything in the world there? No, I just need 3 points explained well. So I'll take 3 of them. Yeah, I'll take 3 of them. All are valid points, but I'll just take 3 of them. And I will say, well, assessing creditworthiness, this will involve obtaining credit rating from the customer or credit rating of the customer from an independent rating agency, which will establish their credit worthiness. If the scores are good, it means the customer is credit worthy. And that's it. This is 1 mark. 1 mark for explaining the point well. The examining team does not want from you a list of things. They don't want 12 different things from you. They want 3 things explained well. Second, it can also be done by researching about the customer and requesting their trade or market references. If these references are good or positive, it means that the customer is deemed as credit worthy in the market. That's it, 2 marks. The final point here I'll take is on the financial statements. Finally, customers' financial statements can also be requested, and these can be analyzed to find the these can be analyzed to find the ratios like gearing, current ratio, etc. If these ratios are good, the customer can be deemed as credit worthy. And that's it. So I've got here 3 marks and I'm all good to go. So please, this is a thing to learn. The thing to learn is that the examining team is not looking for 20 different things here. They are looking for 3 things, but explained well. And this will give me 3 marks on this exam to assess the credit worthiness because I've discussed and explained things well. So I hope that this is very, very useful because this is the deal breaker on this exam. This is the difference between passing and failing this exam. That how good are you with your discussion? Second heading is terms and conditions. Terms and conditions to offer. Now, can you tell me here that what would be the terms and conditions that you will look to offer to customers? Or what are the things that you will think within the terms and conditions heading? So I need few points here of what we will consider within the terms and conditions heading. So a few answers now coming in. Period of credit allowed, their credit limit, their credit amount, settlement date or the timing, credit limit, payment period, credit period. Yes, all are valid points. All are valid points. So this is where the customer's credit period and credit limit will be established. Not enough to stop here. This will not give me much credit in the exam. I need to explain this point further. This will come from earlier step where the customer's credit worthiness was checked. If the customer was credit worthy, they are likely to get higher credit limit and more days to pay. And that's it, 1 mark. 1 mark for saying this on our exam. There are more points coming in. Some other terms, discount limits, interest rate if payment is delayed. Yes, all are valid points. I'll take them now. Additionally, the customer's payment structure and any early settlement discounts will also be established here. These will attract the customers, and they have to agree with these for them to take effect. So the customer has to agree with those discounts or payment structures, and the idea here is that it attracts the customers because the discounts encourage them to pay early, and then we are looking at the agreement of the customers so that this takes into effect. And the final thing here is, finally, this area will also cover any penalties or fines which a customer will have to pay if they default or miss their payment structures. If they miss their payment structures, these will have to be agreed by the customer and may take form of legal proceedings if this happens. And that's it. So another 3 marks here on terms and conditions to offer. And again, there are many other points that you've given me, which are all fine, and you could have brought those points out and written them, but please stop yourself from writing everything you know in the world. We just need a few points explained well. So final, third heading, the operational or day-to-day management of these receivables. That's what we are going to look at next. Day-to-day management. So in terms of day-to-day management, what are the points you think we can talk about? So give me your points on day-to-day management. So day-to-day management of receivables, what we can do. Follow-ups, yes. Factoring, potentially. Credit team following on payments due, send monthly statements, factoring, monitor the system. Yes, all are valid points. All are valid points. So the thing which I would say here for a few marks here is this. Here, the company will have to establish an admin department which will look at follow-ups and collection of money from receivables. The aim of this department will be to send regular statements of account and ensure that customers are reminded of the balances they owe and terms and conditions agreed. The department will also ensure that the money is received and deposited in the company's bank account, and all the associated transactions are conducted in an efficient manner. And that's it. Nothing much to say. You can also think about factoring and say, well, we are in the day-to-day management. We may look at avoiding this cost and then maybe hire a factor which can then do all this for us. So that would be fine as well. The next question here is agent analysis. Yes, we will also send them some agent analysis report. How fast should my typing speed be to make sure I don't waste time? Well, that really depends on person to person. I would say that it should be enough that you don't make many mistakes. And if it is just like how I've just typed my answer, this is perfectly okay. But if it's a little bit slower for you, how I've typed my answer, then that is fine as well. as long as you can cover it up in some of the requirements of the parts of this exam. So the factors can be used here. Again, we don't have much time really to go into details bit of factoring, but again, factoring is where we basically outsource the credit control department, and then factoring can help us in collecting this money and then ensuring that all the reminders are sent by the factor, and the factor will charge us a fee. So we have to ensure that the benefit of having a factor is more than the cost of having a factor. So I can't go much detail in that because we still have to do another question. But I hope that this question was really, really useful, particularly this requirement, because I have seen in the past that how students struggle to come up with points, and when they come up with points, they don't explain them well. So all of you have got a lot of points, and I was really happy to see all those points. But the thing is, we need to understand that we don't need everything in the world. We need selective points, and then those points explained well in this exam to earn the marks. Now, that is it on this question. Good question to start off the things on working capital. I'm going to stop here for about 4 minutes, 3 to 4 minutes. I am still happy to take more questions. So within these 3 to 4 minutes, if you can please send me your questions, and after the break, I'll come answer these questions, and then we'll go into the next part. So 3 to 4 minutes break, and please feel free to drop your questions. Okay, so back from the break. There are a few questions here that you want some information on over trading. Well, if the time permits at the end of this session, I will definitely try to cover something on overtrading as well. But remember that this is a revision webinar series, where we get like 2.5 hours on each topic. So this is not equivalent to a tuition phase. But if I can, I will do my best to go over some of the points that you need more information on in terms of your syllabus. Now, the next thing is that we need to go into another question. The question we need to see now is CSZ question from the June 14 exam. CSZ question. So this is also within the questions with this webinar. So CSZ question, June 14 exam. The reason I've taken this question is because this is an area which sometimes causes a lot of confusion for the students sitting this exam. People do like generally to deal with receivables, with inventory, with cash. But when it comes to dealing with a bit of ratios involved within the working capital, people are not very comfortable with that always. And that is a fear I need to remove. So let's look at this. I just cropped this question. This was fully a 25 marker, but it had areas which are no longer examined as part of section C. So I've removed them. The requirements here are calculate the working capital cycle or the cash collection cycle of CSC at the end of March 14 and discuss whether a working capital cycle should be positive or negative. We have already done some work on the cash operating cycle or the working capital cycle or the cash conversion cycle. They're all the names of the same thing. The calculation there was inventory days plus debtor days minus creditor days. And then we have to discuss whether a cycle should be positive or negative for 6 marks. Let's do this first and then come back to the remaining things. So let's go into the question. The current assets and current liabilities of CSC at the end of March 14 are as follows. So they have their current assets and current liabilities at the end of March 14. So here are the current assets. Here are the current liabilities. Inventory will be used for inventory days. Receivables will be used for receivable days. And the payables will be used for the payable days. For the year to end of March 2014, so this same timing, CSC had domestic and foreign sales of 40 million. So here are the sales which will be used for finding the debtor days or the receivable days. All on credit, while cost of sales were 26 million. So cost of sales to be used for the inventory days and the creditor days. For the inventory days and the creditor days, $26 million. So this is the information we have to work out the cash operating cycle. And we don't need anything else really. We do not need anything else here. So what I want you to do is to go to the calculation of cash operating cycle. And let me just go there. Here. So I want you to calculate for me, the payable days, inventory days, receivable days in this question. So let's do that together. Oops. So we can do this on extra constructed response workspace. Let's look for a spreadsheet here. Okay, so this is the CSZ question. And we are looking here at part A, which is the cash operating cycle. And I want to find 3 things: the inventory days, the debtor days, and the creditor days. So how do we calculate the inventory days? We take the inventory over the cost of sales. So inventory over the cost of sales. So the inventory here is 5700. The cost of sales is 26 million. And how many days are here in a year? It doesn't say anything, so we assume that's 365. If the examining team is specific, they will tell you something else, maybe a 360. So 5700, 5700 over the cost of sales, which are 26 million, 1, 2, 3, into the 365. So this should give us our inventory days calculation. So our inventory days at this point. So inventory days come out to be 80.2, 80.02. So in the same way, we'll do the debtor days now. So for the debtor days, we'll take the receivables, which are 6575, 000 over the sales, which are 40 million, into the 365. So that gives us our debtor days, which come out to be 60. And then finally, our creditor days, which will be the purchases to the trade payables 2137, 000 over the cost of sales, which were 26 million, into the 365. And that gives us the creditor days, which come out to be 30. So the cycle then is inventory days, which are B5, plus the debtor days, which are B7, minus the creditor days, which are B9. And that gives us the cash operating cycle here of 110 days. Cash operating cycle of 110 days. Now, any questions here with the calculations first before I go into the discussion on this? Any questions here with the calculations? I hope that was relatively straightforward. Inventory days, debtor days, creditor days, and then working out the cycle. Okay. Question is, should we write our answers in bullet points? Well, not really, because the bullet points encourage you to write less. It should be a discussion. So how I'm doing my answers is what I want you to do in the exam. Please show creditors working. The sale will be total domestic and foreign. Well, there wasn't anything really specific on that, so I'll just assume that is my total sales. Had domestic and the foreign sales, so that is your total sales. So nothing to worry about there. So the creditors, 2137,000 payables over the cost of sales of 26 million into the 365. Now the discussion. They asked us to say if this cash operating cycle should be a positive or negative. Well, I'll just say the same thing here, which I wrote with you while I was doing this discussion earlier, that a positive or negative cash operating cycle depends on a range of factors. It depends on whether a business is retail, which is B2C, or B2B, as these will have a different impact on these calculations. Retail transactions are usually on cash, which means there will be less receivables and payables. It also depends on the type of industry. It also depends on the type of industry, i.e., if it is service or manufacturing. As again, these will impact on the receivables, payables, and inventory days. So the answer to this is basically we can't really establish unless and until things are clearer to us in terms of what sort of industry is it, what sort of business is it, and things like that. A few more questions. Can we also discuss about foreign receivables and payables? Well, no, it didn't ask us to do, so refrain from any such things. Is it necessary to mention formulas in Excel in exam, or we can calculate it from our calculator and just write the figures? Well, the examining team doesn't really like that, and they've mentioned that on the previous examiners' reports as well, that what's the point of having a spreadsheet if you still have to do your numbers on the calculator? So you must be using the functions in the spreadsheet, because it just doesn't look good that you're doing the calculator and then putting the final answers there. That final call is on the examining team. I'm not the best one to say whether they will give the marks on that or what would be the marking arrangement there. But what I would say is that whatever you see me doing on this revision webinar series, that is what you need to come up with in the exam. So do your calculation on the spreadsheet and just not the calculator. Final question here is, can you explain B2C and B2B? B2C is what you see in your real life, where you go to different shops and the businesses sell to you as consumers. B2B is where two businesses transact with each other with an aim of doing some business. Now, that's it. So this is my final answer here on this requirement, which was part A, thinking of some numbers for 3 marks and then some discussion for 3 marks as well. Now, let's go into the next part. For 5 marks, the examining team then wants me to calculate the target quick ratio. Target quick ratio, acid test ratio. Can you tell me what is a quick ratio? What is a quick ratio? What do you know about the quick ratio? What is a quick ratio? Quick ratio. Current assets minus inventory over current liabilities. Yes, good. Yes, well done. So we all know what's a quick ratio, and we have to compute that quick ratio here. So current assets minus inventory over current liabilities. And the target ratio of sales to net working capital. Sales to net working capital. So the examining team wants us to do this ratio, sales to net working capital. So if I can just do some notes. Sales to net working capital. So the quick ratio is current assets minus inventory over the current liabilities, and this is the sales over net working capital ratio. And we already know how to compute the working capital, which is current assets minus current liabilities. So what are the sales generated by the working capital employed of CSE at the end of March 2015, which is the next year? So that's what we need to do for 5 marks here. We need to find the 2 ratios for the next year in this requirement. So let's read this further. For the year end of March 2015, so this is focusing on B, CSE has forecast that credit sales will remain at 40 million. Credit sales will remain at 40 million, while the cost of sales will fall to 60% of sales. So 60% of sales, this will be the 40 million, 60%, this will be the cost of sales, whatever you get on your calculations here. The company expects the current assets to consist of inventory and trade receivables. So current assets will be the inventory and receivables, and current liabilities to consist of trade payables and the overdraft. So trade payables and the overdraft. CSE also plans to achieve the following target working capital ratio values for the year end of March 2015. So these are the inventory days given, receivable days given, and the payable days given, and the current ratio. I'm going to use all this data here to work out these 4 things. I'm going to use all this data here to work out the 4 things. Now, this is what the students do not like doing. And this is what we have to do today to be comfortable with this area. Now, before I go into this working on this question, what I want here is for you to go back to something we talked about earlier today, where we thought about how to find the receivables balance. Well, we have receivable days, and then you can rearrange it to find the receivables balance. Now, I want to just do something more here. So we just want to make a note of this. So the first thing is to find the receivable days. We know it's the receivables balance over the sales into the 365. And to find the receivables balance, we say sales into receivable days over 365. That is how we find the receivables balance. Now, I can do the same thing with inventory and the payables as well, because I know that the inventory days are inventory balance over the cost of sales into the 365. So how can I find the inventory balance here? Well, I'll do the same thing. The inventory balance is the cost of sales into inventory days over 365. Exact same thing. I'm just rearranging the above calculations to find the balances. So these are the balances we're trying to find out. I'm just rearranging this calculation. The third thing is the payable days. The payable days are payables over cost of sales into 365. So how can I find the payables balance? Well, the payables balance is cost of sales into payable days over 365. And then that's it. Now, this is a struggle for some of the students because they don't understand how these values are being worked out. But can you please keep this in front of you while I'm going to do this question? Because I am going to use these calculations now. I'm going to find out receivables balance using this, to find out inventory balance using this, I'm going to find out the payables balance using this. So we need all these calculations here to be able to do this question. So is everyone okay with what we're going to do here? Are we okay with rearranging these formulas to find these balances? So if you've got any questions on them before I move on? So any questions on these rearrangements before we move on? Okay, so that seems okay. Let's go into the workings on this now and trying to find out these values of receivables, inventory, and payables. Back here. So I can just do it here. This is B. So we have to find the quick ratio and sales to net working capital ratio. 2015. To do that, the first thing is find the cost of sales. And the information in the question said that the cost of sales for next year will be 60% of sales. So 60% of the 40 million. So let's take the 40 million, take 60% of that, and that gives me the $24 million. $24 million is your cost of sales. Now, I want to find the inventory balance. I want to find the inventory balance. To find the inventory balance, remember the calculation here is what I showed you earlier, which is cost of sales into inventory days over 365. I already have the cost of sales. Do I have the inventory days for the next year? Yes, we have the inventory days for the next year, which are 60 days. So what I'll do now is I'll take the B25 into 60 days over 365. So inventory balance is cost of sales into the inventory days over the 365, which you can see here. Inventory balance is equal to cost of sales into inventory days over 365. You need to keep this in mind. You need to keep these calculations in mind to be able to do this well. And this gives me the inventory balance here, which comes out to be 3945205. In the same way, can I ask you, with this information here, to find the receivables balance? So I want you to find the receivables balance for me, thinking of the rearrangement in the same way. So receivables balance, remember, sales into receivable days or 365. And remember, we have the receivable days of 2015 given as 75 days. So can I ask you to find for me the receivables balance here? Can you find the receivables balance? So some answers are coming in. So I want everyone here to try and find the receivables balance. Focus on this calculation, please. The calculation here is sales into receivable days over 365. Do we have the sales? Yes. Do we have the receivable days for next year? Yes. And we know 365. So can I ask you to give me the receivables balance? Receivables balance for next year, 2015. Yes, so some correct answers given in. Well done. Well done. So we are taking the sales, which are the 40 million, into the receivable days 75 over the 365. So this will give me the receivables balance for 2015, which comes out to be 8219178. So well done to everyone who got 8219178. 8219178. Now, last thing here, we have to work out the payables balance. Or in fact, I think we don't need the payables balance. We don't need the payables balance because we have the current ratio given. So I'll tell you how to use that. 1 second. So can I ask you to first of all give me a total of this, the current assets. Remember, this company's current assets were only made up of inventory and receivables, which I've got now. So the inventory was in B27, receivables were in B29, and this is the current assets. Current assets. Current assets are 121,64384. We can find out the current liabilities now as well. We can find out the current liabilities here as well. So the current liabilities calculation. Okay, we can do the trade payables. Yes, we can do the trade payables. So trade payables balance. Trade payables balance. We have got our calculation here, which is giving us the cost of sales into payable days, cost of sales into payable days over 365. So cost of sales, which is in B25, into payable days, which are given in the question as 55 over the 365. And that gives us the trade payables balance as well. Yeah, that gives us the trade payables balance as well. 3616438. Now, can you think of an issue with this calculation now, which I have done? So because of doing this trade payables calculation, can you think of any issues that have arisen here? Any issues that have arisen at this point? Well, yes, the overdraft is not calculated. Well, I told you, well, we don't really need the trade payables here because I do not have information to do the overdraft. Remember, their current liabilities were trade payables and the overdraft. So how do we get that information? There was no information on that, but instead I have the current ratio. Yes, smart, well done. Current ratio. So let me just give you this now. Let me just give you this. So if I know that the current ratio, is current assets over the current liabilities, and I already have the current ratio given to me in the question, and that current ratio was given as 1.4. 1.4. And I have now calculated my current assets. So can I just rearrange this to find the current liabilities? Yes, we can. So the current liabilities will be the current assets over the current ratio. So the current liabilities, so we don't need the trade payables really. The current liabilities will be the current assets over the current ratio. So current assets are in B31, and the current ratio given in the question is 1.4. So current assets over the current ratio, and that gives us our current liabilities, which are here 8688845. Okay, so I've got my current assets and my current liabilities now. Any questions at this point? This was a tricky part here in this question. Remember, inventory balance we could have found, receivables balance we could have found, we can find the current assets. We can find the trade payables as well, although it wasn't needed. Why it wasn't needed? Because I already had the current ratio given to me. The current ratio given was 1.4. And I know that current ratio is current assets over current liabilities. So if I have a current ratio of 1.4 and I have my current assets calculated, so I can just rearrange this to find the current liabilities. And that's what I've done. I've said current liabilities is equal to current assets over 1.4. And once I've got this one, we can simply now do the quick ratio. And the quick ratio is current assets, which are the B31, over current liabilities, which are the B35. So B31, B35 gives us the quick ratio. Okay. Any questions here up to this point? Any questions here up to this point? Oh, yes, you picked it right again. We should exclude the inventory, as that was what I was waiting for. The quick ratio is current assets minus the inventory. So we just need the receivables part here. And the receivables part was the B29. So receivables over the current liabilities. Well done. Well done. Well done to all those who picked this. That the quick ratio would now be 0.95 because we have to exclude the receivables. Yeah, 0.95 times. Well done. Yes, well done. Current assets minus inventory over the current payables. Now we're done with the quick ratio. Just one final thing here, which is the sales to net working capital. Sales to net working capital ratio. So sales over net working capital ratio. So sales over net working capital ratio. We have the sales information and we have the current assets minus current liabilities information as well. So the sales to net working capital, I can simply do this calculation. Sales was 40 million. So 40 million over the idea of current assets minus current liabilities, which was in B31, minus the current liabilities of B35. That is the sales to net working capital ratio. And that sales to net working capital ratio now comes out to be 11.51. So sales to net working capital, which is current assets minus the current liabilities, 11.51. And that's it. So that is my 5 marks here, which were split here into this way. So you would have got 1 mark for doing this. You would have got half a mark for doing the receivables. Half a mark for doing the receivables. You would have got half a mark for doing the current liabilities. So half a mark for the current liabilities. You would have got 1 mark for doing the quick ratio. 1 mark for doing the quick ratio. 1 mark for doing the sales to net working capital. And 1 mark for doing the net working capital. So basically 2 marks here for this final ratio. So that is your 5 marks here. Now I'm okay to take some questions at this point. So can I have some questions? Questions. What can be a reasonable ratio figure for quick and current ratios? Well, I think you are trying to find here the standard. The standard here, I would say a standard here is 2 to 1 for the current ratio, because sometimes I hear students saying, well, a reasonable current ratio is 1 to 1. Well, if it's 1 to 1, that means all your current liabilities and current assets are basically pledged, and you don't have anything to run the business. So a safer quick ratio is 2 to 1. So that is having 2 times current assets for the current liabilities. And a safer quick ratio, I would say, is 1.5 to 1. But then again, these are general guidelines. What we are looking in the question is some sort of competition or industry information. Some sort of competition or industry information. Next thing is sales to net working capital ratio tells us what? It tells us that how much of working capital are we using and what are the sales are we generating. Please repeat the ratio. I'll do that. The ratio here is simply taking the sales in the numerator, dividing that with the working capital. And working capital is current assets minus the current liabilities. So sales over the net working capital. And that gives us the sales to net working capital ratio. Any more questions here before we move on? Any quick questions here on things? So I'm happy to answer any questions at this point. Okay, good requirement. Really, really good requirement. And this is something which is not done well in the exam conditions. And I hope that this question will help you to develop the confidence of doing something like this in your exam. Yeah. So, next thing now is to go back to the question and finish this off, the CSC. Last part here is to analyze and compare the current asset and current liability positions for 2014 and 2015. Analyze and compare the current assets and current liabilities position for 14 and 15. And discuss how working capital financing policy of CSC would have changed. Well, the working capital financing policy, I hope that you remember these things here. Aggressive policy, conservative policy, matching policy. So remember, in aggressive policy, the higher proportion of short-term financing is used. In conservative policy, more of long-term financing is used, and matching is just based on the timing. If it's a short-term assets we're looking at, we are using short-term funds, long-term assets, long-term funds. So we have to analyze and compare current asset and current liability positions for 14 and 15. Now, this is another requirement which is not usually liked by the students. So let's think of this. In 2014, what were our current assets? They were 12,275. What were our current liabilities? 6,819. So let's take these from here. So this is C, current asset and current liability positions. Current assets and current liabilities positions. Okay. In 2014, my current assets and my current liabilities were 12,275,000, 12,275,000. And the current liability was 6,819,000, 6,819,000. This is what happened in 2014. In 2015, we already have the numbers with us. So current assets are here, which are in B31, and current liabilities are here in B35. So B31 and B35. So B31 and B35. So here is our analysis or our comparison, basically, of the current assets and current liabilities position. So in 2014 and 2015. Is there any ratio which I can do here to help me in this analysis? Is there any ratio which takes into account the current assets and current liabilities I can do here, which will help me in doing this calculation? So answers coming in now. Yes, current ratio. Well done. Current ratio. So we can do a quick current ratio here. So let's do the current ratio. Current ratio is current assets, which are B44, current liabilities, B45, or C44, C45. So I've got my current ratios. So what are these current ratios telling us here? What are the 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 current ratios telling us here? Yes, right. So all of you can see here that the current ratio has deteriorated. The current ratio has deteriorated. Okay, so I can put a point here at this point and say, well, current ratio has deteriorated, which means that the company has less current assets to cover their current liabilities. So they have less current assets to cover their current liabilities. That is what this ratio means. Yeah, well done, well done, well done. Then at this point, we need to do some further analysis. Now, the further analysis I can do here is because they asked us, I've done the comparison on my current assets and liabilities, but they also asked us to link this to the working capital financing. So what I can do here is I can do a little calculation where I can do the current liabilities percentage. Current liabilities percent. So what are the current liabilities percentage here? So I can say B45 over the B44. The current liabilities percentage. I can do the same thing here, C45, C44. The current liabilities percentage. So 55% and 71% is the current liabilities percentage here. So current liabilities from the current assets, or current liabilities for the current assets, 55 and 71. Now, can you tell me that what sort of policy is this hinting? So if a company has used about 55% short-term funds, this is close to which policy? Is it the aggressive policy where more reliance is on short-term funding? Is it the matching policy where it's like close, it's like balanced out? Or is it like conservative where the short-term financing is less? Which policy do you think this is linking to? 55%. This is close to what policy? Yes, matching. I like that. This is close to matching. So you can say a bit of aggressive and matching, but it is more of matching because it's like 55 to 45% in terms of financing. This one is obviously aggressive. This one is obviously aggressive because more reliance is placed on the short-term fundings. So what I can say is that in 2014, the company was relying more on, current liabilities in a balanced way and close to matching financing policy. Matching financing policy. In 2015, the company was relying more on current liabilities and close to aggressive policy. And then that's it. This is what the examining team wanted from us. A good comparison and analysis of things. So this has also enabled us to revise a bit of financing of the working capital. And I am at this point open to any questions. Any questions at this point? Any questions at this point before we move into the other things? Okay, this seems all good. This is a really, really good question. Please practice this a few times. Really good question of thinking about a different aspect on working capital, and just not the traditional receivables and inventory, but thinking about some things on ratios, thinking about the financing policies on working capital. So I hope that this was useful. Now, we have a bit of time here, so I am going to go into few more things which would be of benefit to you for working capital. And what we can do here is this. We can think of something to do with the overtrading as well. Overtrading. So can you explain to me, so what is your understanding on overtrading? So if I can please have a bit of points on overtrading. What do you have on overtrading? What do you know on overtrading? Well, overtrading is where you have excess inventory. Okay. What else do you know on overtrading? Less investment in working capital. Okay. Increase in sales. Rapid growth. So all of you are giving me so all of you are giving me some pointers which are telling me about the factors or the symptoms of overtrading. So it is when a business relies on short-term funds to grow. The business relies on short-term funds to grow. This is where we say we are having an overtrading situation. So it is when a business relies on short-term funds to grow. For any growth, so usually a business will rely on long-term funds, which are equity plus the long-term debt, to grow. And when this is not happening, it is called overtrading. It is called overtrading. Another name of overtrading is undercapitalization. And that name is it means that basically we are having less of equity and long-term debt. This is called undercapitalization. So this is what overtrading is, undercapitalization, where we got less of equity and long-term debt to grow, and we are relying more on the short-term funds to grow. So I hope that is clear. The opposite of that is obviously overcapitalization, where you are using more of equity and long-term liabilities. Now, the examining team would like you to tell them some indicators of overtrading. So what will be the indicators of overtrading? So there are some indicators of overtrading, and some of you have already given me some indicators. The first indicator is that you have got rapid growth in sales. The first indicator is that you have got rapid growth in sales. The second indicator is that you are maintaining high inventories because you want to sell more. So you're maintaining high inventories. Number three, you have high short-term borrowings and less long-term borrowings or less long-term funds. So high short-term funds and less short-term, high short-term funds and less long-term funds. 4, you have poor current ratio and quick ratio. Why do you think a poor current or quick ratio is indicating towards an overtrading? Why do you think a poor current or quick ratio is indicating towards an overtrading? Poor current or quick ratio. Why is it that indicating towards overtrading? Yes, because a poor current ratio means that we've got more reliance on the current liabilities. And poor current ratio and quick ratio just means that we have got more of current liabilities to grow. 5, receivables and payable days. Receivables and payable days. So high receivable days and payable days. Because high receivable days means that we are just selling too much and we are trying to encourage customers to take it on credit just to increase our sales. That's why our receivable days are too high. And of course, the payable days are high because we just are not being able to pay on time. So we are selling more basically, but we are not paying people on time. So our payable days are not looking good. Finally, the poor cash position. Poor cash position. And this is where you need to work out your net cash. And net cash is your cash plus overdraft. Net cash. So if it's a poor cash position, it also suggests that you are overtrading. So these are some indicators of overtrading that we need to know. And of course, there will be some calculations involved here. Don't do all the possible ratios in the world and focus only on the ratios which are key for you to get through these indicators. Sales to net working capital ratio, yes, that's another one. That is another one. Sales to net working capital ratio is a good one. And again, on this area of overtrading, we can do like 20 different indicators. I can write here about 20 different indicators, but would we need all those 20 in the exam? No, we just need the key bits. And these are the key indicators here on the overtrading. And you'll have to do a bit of ratios, work out receivable days, which you know now, to work out payable days, to work out current ratios, quick ratios, and then be able to think about these indicators. So that is what overtrading is really all about. There's a good past question if you would like to have a look at that. The question is Crago. So if you just search on that, Crago is a good question on overtrading. Crago. I don't really remember the year right now, but this is in the last few years, Crago question. I think it's a 10 marker somewhere. So if you do a little research, this is a good question to do on overtrading. So that is on overtrading. Let's just also do something on the cash management models. Let's just do something on cash management models. Cash management models. And what we're looking at here are two models, which are Miller-Orr model, and the Baumol model. Miller-Orr or the Baumol model. In terms of the Miller-Orr model, let's just focus on that first. Miller-Orr model. In the Miller-Orr model, I can explain it here using a bit of a diagram. In the Miller-Orr model, this is your cash balance. This is your cash balance. And this cash balance goes up and down, cash balance. And these are the three limits that are set. This is the maximum, this is the minimum, and this is the return point. Maximum, minimum, return point. Maximum, minimum, return point. Can anyone here tell me that why these limits are set? So what is maximum limit? What is minimum limit? What is return point? What do you know about it? So tell me, what are the maximum and the minimum limits? Maximum and the minimum limits. Why these limits are set? So what is your understanding on this? What are the maximum and the minimum limits? Minimum cash to be held. Maximum limit is where we start investing cash in short term. Minimum limit is cash should not fall below this, cause of budgets. Yes, good points again. So maximum limit is a point where if your cash hits this maximum limit, you invest in short-term markets. Invest in short-term markets. And when your cash hits the minimum limit, you divest from the short-term markets. Divest from short-term markets. And why do we set these limits? Because the senior management sets these limits so that the staff know what they have to do when. So whenever the cash hits the maximum limit, invest. Whenever the cash hits the minimum limit, divest, take the money out of the markets and put it back into the bank account. The return point is like a safer limit. A return point is like the safety point. So that's the safety point which they must try to maintain. Now, the other important thing here is that you need to know what is the difference between these 2 points, maximum and minimum. This difference is called the spread. Spread. This is called the spread. This here is the 2/3 of the spread, and this here is the 1/3 of the spread in terms of the allocation of the spread. So spread is the difference between maximum and minimum limit. 2/3 of the spread is the difference here. 1/3 of the spread is the difference here. Now we can find the spread using our formula sheet. So on the formula sheet, you've got a really nice formula which has got the spread calculation, which it shouldn't be a problem because all the things are given in the question. It's just that we should be able to use it. So you can use that spread formula to find the spread. This minimum level will always be given to you. And if this minimum level is given to you, if the minimum level is given to you, then the maximum level is basically minimum level plus the spread. Simply. Yeah. The return point is the minimum level plus the 1/3 of the spread. So we need to find the spread using the formula sheet and then be able to calculate these maximum and the return points as well. Remember, the minimum level will always be given to us. The minimum level will always be given to us. Now, the next thing is the idea of the Baumol model. Baumol model. Baumol model, I simply say, is the EOQ of cash. Baumol model is the EOQ of cash. Baumol model is the EOQ of cash. Now, what we say here is 2COD over CH. Baumol model is the EOQ of cash. Here, these are things. CH is the interest, the opportunity cost, interest. CO is the transaction cost. And D is the annual demand of cash. Annual demand of cash. Yeah. So what is the Baumol model trying to tell us? It helps to find the best quantity of cash to deposit in bank to meet annual demand, keeping costs low. Keeping the costs low. So help to find the best quantity of cash to deposit in the bank to meet annual demand, keeping costs low. And then again, the costs here are basically these: the CO, which is transaction cost of depositing money in the bank or taking money out of the bank, and then the CH, which is the interest foregone. So again, in the scenarios, you would be given information about transaction costs. We can't find that; it has to be given. Interest foregone would be given as well. We can't find that, and then the D, annual demand of cash, and then we simply find out in dollar terms what is the EOQ of cash, what is the best amount of cash that you need to deposit. Now, this is it on the cash management models. What I would like you to do later, this evening or tomorrow, is that there are some other good questions as well here. There are three questions. One is NICID question, one is Pangley, and the other is TGA. These are all really good questions, working capital. We just had time constraints here that we couldn't do these questions in exam time. Otherwise, I would have loved to do them. So you can try these questions, and two of them are quite recent in the last few years. And I've taken June 13 exam as well, TGA, and all these questions are there with you. So I hope that this would help in your practice on working capital. I just have a few more minutes here, and I am happy to take any questions from you. So I'm happy to take any questions from you at this point. Few questions on working capital if you may have. The question is how to use the spread formula in Excel. Let me see if I have the Excel on, if I have done this somewhere so that I have the numbers with me. I don't have any numbers right now, but the calculation is simple. So always try to think of how you will do it on the calculator, and then how you would do it on your spreadsheet. So it's the bigger 3 outside in the brackets. So it's a bigger 3. That is the last thing you do. But first solve the bracket, and then after you solve the things in the bracket, you simply multiply that with the 3. So I don't have the numbers with me right now. Otherwise, I would have shown you something on that. Any more questions here? So the questions here are coming in, which are the annual demand in the model is for the use. Yes, the annual demand of cash which you're going to consume. That is what we use in the Baumol model. The next question is, what if the question asks to state ways to improve cash management? Well, the ways to improve cash management is that you need to be good with the budgeting. You need to be good with the forecasting. You need to be good with the idea of collecting your receivables quickly. You should be able to manage your payables well. You should be able to manage your short and long-term financings well, because all of these involve cash. So there are lots of different ways in which we can do it. Did not touch cash budgets. Well, we didn't have much time really to go on the cash budgets, but cash budgets are simply inflows and outflows. So there's nothing much there. You will have opening balance of cash, some inflows, remove the outflows, you get a closing balance. So again, this was not, the aim here wasn't to cover everything on working capital. The aim was to focus on key areas and do some question practice. So I hope that this was very, very useful. Well done for your interaction in today's session. Very interactive session. So I really like that when you give me the answers to things. So I hope this was really, really useful. And I'll see you with the last session, which is on valuations and risk management later. So good luck with your preparations in these last few weeks to the exam. And again, as always, if there are any questions you may have on these areas, please feel free to drop me a line, and I will come back to you at some point, but ASAP. I'll try my best to come back to you ASAP. So thank you very much, and good luck with your studying.